I expect a fairly stable Chinese economy in 2017. The worst is probably behind us, but it will also take some time before meaningful growth can be seen.
Producer Price Index has turned positive, suggesting potential improvements in earnings for industrial and manufacturing companies. Having said that, though, we still expect the pace of recovery to be relatively slow.
I still expect consumption to gain further importance as the wage effect of Chinese residents should continue to positively contribute to the overall economy. Conversely, the export sector would stay weak because global trade is unlikely to pick up significantly as developed economies globally are still only slowly climbing out from the basement.
The leadership transition in 2017 means that the government will stay committed to achieving the growth targets, and stability will remain policy priority. We expect fiscal policy to remain expansionary, with increasing use of quasi-fiscal channels such as policy banks and PPP projects.
The government is also actively addressing domestic debt issues by rolling out more policy such as the debt swap for the local government debt and the debt-to-equity swap program. They have also introduced measures to expand the funding options for companies by opening up the China's corporate bond market, including the panda bond market.
We expect it to be a benign cycle in China, even though inflation may be going up, led by PPI inflation and renminbi exchange rate uncertainties. A stable monetary policy is essential in fostering growth of the economy.
On one hand, people could argue for more easing of monetary policies because of the still sluggish economic conditions and the slow inflation outlook. However, on the other hand, loose monetary policy would only stimulate the economy through more lending, which is a problem that China wants to avoid now.
Asset bubbles, as well as capital outflows and renminbi depreciation pressures, have raised a hurdle for broad-based monetary easing. However, we expect the PBOC to continue using its liquidity facilities and open market operations to maintain stable credit growth, liquidity, and interbank rates to support fiscal spending and overall economic growth.
Regarding favorable sectors, the easy answer would be the new economies, including internet, media, and high-tech sectors in China, as these sectors are aligned with the government's growth target and will be subject to more favorable policies. At the same time, these sectors also benefit from wealthier consumers, while the biggest of these companies are also making good progress in the overseas markets.
We see value in technology, which will be benefit from policies promoting technological innovation. We are also positive on selective state-owned enterprise and local government financial vehicle, also known as LGFV, and we try to focus primarily on companies with strong strategic importance for the Chinese government.
Other than the long-term winners, such as the new economy stocks, we also favor infrastructure-related names on the back of the new PPP projects. We also think the financials may perform better in 2017 as globally long yields may continue to pick up.